So you got the property growth cycle. So I'm going to start at the start of the cycle. So you go through this period of upturn. So in a growth cycle or in a property cycle that I'm going to be talking about, I'm going to talk about the stages of the growth cycle. And this was taught to me by one Biz Shrapnel, which is Biz Oxford Economics, or Oxford Economics, I think they are now. And also one of my mentors was an ex-valuer and a few other bits and pieces. So he really drilled this aspect or this theory, and I got quite immersed in this because I got it wrong and I got my ass kicked pretty bad in a town where I lost money. Not very much money, but I lost money on a deal because I didn't understand this market cycle. So it is important with developing to understand the broad market cycle. It's more important if you want to hold properties long term. And then with bigger projects, like the size of the projects that I'm doing at the moment, it's even more important because they are taking 3 to 5 years plus. So I've got to make sure that I nail this because I don't want to be in a declining market, for example. So you've got what's called an upturn in the market. So, you guys all know that we've pretty much experienced it around Australia the last few years. So the market grows, and this normally lasts, I'll use a different color. This can last for 2 to 3 years, not 2 to 5. This is normally 2 to 3 years. I explain this in the accumulator training as well, even in the brief training, if you guys have watched that. So this period of time is 2 to 3 years. That's it. So normally what happens in a growth cycle is it grows, property grows for 2 to 3 years. And then that's it. You reach the peak of the market and then it normally plateaus. And then you have this downturn. So you have a downturn in the market, which is called stagnation or downturn stagnation, same. Now this downturn, that doesn't necessarily mean that values are actually dropping. So this is what's happening in a lot of areas. Just because values aren't dropping, that doesn't mean that the property market is necessarily or technically staying the same, because you've got to allow for inflation as well. So if the property value stays exactly the same and you've got 6% inflation like we have now, well, technically the property's going backwards by 6% per year when you consider it like that, because inflation is on the value of money. The value of money is getting less. So if that property is $1 million last year and it's $1 million now, technically the real value of that property is actually less 6% if inflation is running at 6%. And hopefully it's not that high for much longer, but that's what it is at the moment. So if your property is doing nothing, not growing in value, you're technically losing 6%. So that's what's called the real property value. So this downturn stagnation, and this can go for a long time. So this can go for, hopefully you guys can see that. Let me know if you can't see that. So this is 2 to 5 years. I'll use the blue. So that's 2 to 5 years typically. Now, it doesn't always go by these numbers. This is just general assessing across all markets and all market cycles. And then what happens is you then start the uptick again. And then you go through the same 2 to 3 year boom cycle. Okay, does that make sense to everyone? So you go up. So hopefully this all is pretty easy, because I'm going to get a bit more technical now around what markets look like and when you should be getting into those markets. So you go through a 2 to 3 year up, then you go through generally a 2 to 5 year down, stagnation, and then you go through 2 to 3 up. That's it. Pretty straightforward, really easy. Where it starts to get more complicated is when the up lasts for the 2 years and the down lasts for a lot longer. So just have a look at what Perth has done over the last 10 years. So a lot of regional markets have been in stagnation, this 2 to 5 year period, for a lot longer than 5 years. Like if you even consider Perth, and I'll call Perth a regional market, even though it's a capital city, it's technically, it's isolated from the rest of Australia, and it's heavily reliant on mining. I don't care what anyone else says. One mining job creates like 15 other associated jobs as a result. So if you got one person working in the mine, it's going to create all these other associated roles, because people are coming back into Perth. You've got all of the infrastructure running through Perth. You've got people in head office running from Perth. So anyway, I believe if the arse falls out of mining, so to speak, in a nice way of putting it, if the arse falls out of mining, whether that's iron ore or coal or both, then Perth's market will crash and burn. And that's what happened in 2012 and 2013, when the price of coal was up really high between sort of 2012 or 2011, 2012. Coal was booming. And then Perth, along with a lot of other mining towns and, other mining towns, not just in and around Perth, but also Western Australia, Queensland, everything boomed and then everything bust really bad or went bust. And that's exactly what happened with Perth. And that was like, 10 years ago. And now Perth is having a really good run. And I think Perth's overall market probably has another 12 months to go. Some pockets maybe even a bit longer. The ones I was looking at may even have longer than 12 months to run. So that's Perth market, and other regionals, they can go for longer and then stagnation for 2 to 5 years. So if you're in a regional market, don't get this wrong, because you might be left holding the property with negative equity if you're holding for 10 years. It could really stuff you up. So I've got a property that I purchased is a heavily reliant mining town, but it also has a lot of other economies, and it's 100,000 people. And I've had that property for nearly 10 years and it hasn't done much. The only growth it's had has really been in the last 18 months. But I've waited almost 10 years for that. And I just sat on it, realizing that I got in at the wrong time of the market, and then just left it there sit. So it wasn't too bad. It was a buy and hold property. It pretty much covered its own expenses. But it is a development site, and I was planning to develop it, and it hasn't been developed. I got the approval. I've extended the approval twice. I haven't developed it because the market has been soft in that area. So what you should be looking for, if you're in a market where the market has gone nuts for the last 2 to 3 years, I'd be very cautious. And when I say gone nuts, have a look at a lot of coastal areas. So a lot of coastal, and we have just been through a weird market cycle where we've had areas boom more than what they should have off the back of hype. You got to remember that property is still it's a physical, tangible asset that people live in. So it's driven by human emotion. So coastal areas that boomed were driven by human emotion of people getting out of COVID and wanting a holiday home. Now, a lot of business owners had surplus cash because the government gave them or gave us a lot of surplus cash during COVID. I know one of my investors had a $5 million payroll tax bill paid for him over COVID by the government, and his business was still making a lot of money. So, if you got businesses that get an extra $5 million cash, what are those guys going to do with it? If you're in the middle of COVID, you got $5 million cash, you go to a coastal area and go and buy a holiday home with the $5 million the government just gave you. So there's that consideration around coastal. So a lot of the coastal areas have gone through this. Especially in that luxury market end, I'm seeing it unravel in certain pockets. It hasn't hit the media. I was going to say it hasn't really hit the media, but it hasn't hit the media. But I'm seeing it. I'm seeing things sort of on the sideline. I'm not actively in that market, but I'm seeing sort of what's coming. That's my crystal ball. But when you're in a market, if it's grown massively in 2 to 3 years, just be cautious, because you're probably going to go through this 2 to 5 year. And I think this 2 to 5 years is going to get cut short only because of the undersupply. Because what normally happens, what drives the growth is actually construction, so undersupply. So where we are at the moment, a lot of Australia has already gone through this uptick. Sydney experienced it early, and a lot of parts of Sydney have already come off. If you have a look at parts of Sydney that have gone down by 20% in the last 12 months, they're already in this 2 to 5 year segment, and maybe they've got another 12 months to run, or maybe they've started to uptick already. Maybe that 2 to 5 years has been cut short because there's no supply. So when we look at suburbs, we don't know where we are on this 2 to 3 years, and we don't really know where we are on this 2 to 5 years in the stagnation. We can only take an estimated guess as to what's happening in the area and in the market. So normally what happens in the uptick is you start to see, and I'll use this part just because it's easier for me to lean on the board. So you've just come off this downturn. So when you look, and if you're looking at data, particularly if you're in the accumulator, you can only look at data at this point here, and data takes time to catch up. Even if it's recent data, it's still going to be behind where you are in real time. So that's why I don't always like to rely on data, because you normally, if you look at data, you're actually late to the party, which is okay, being late to the party. You just don't want to be too late. Like if you're looking at data here and you're looking back and you go, okay, well, there's maybe a little bit of growth, and then you look back further. So this could be, 6 months. You might look back 6 months and you might have had, say, 2% growth. But this is a typical value. 2% growth could just mean that suburb or that area had a couple of high-end homes sell, and it looks like it's growing, but it's not actually. It just could be a couple of weird sales where they're high-end. So there was like a sale around this area, a couple of suburbs away. It's like 25 million. So that's not very typical. You don't have a $25 million sale, every month. So the other properties in that area generally are probably going to sell for between, let's just say, 2 to 4 million, and then you got a $24 million sale. So it's going to spike the data. So it might look like that area is growing, but in reality, that's just one sale skewing the data. So you got to think about that as well. You got to also look at number of sales. So if you look at the last 6 months, say, it might look like it's doing 2%. It could be a false reading. So this is where you've actually got to get on the ground and actually look for stuff. Then you might look at the last 12 months and you might see negative decline because you've just come off this. So you're coming out of the bottom and into the top. So you don't know whether you're here or whether you're further on down the track. So whether you've just come off the peak and you're coming down the other side. So the only way to really know and be like 100% certain that you're actually in this growth market is actually to enter it after it's already had at least 6 to 12 months of growth. That's, in my view, that's to be certain that you're actually in a growth market. You can see signs early, like days on market start dropping, which means buyer activity. So you can always look to these signs, but it could just be a little bump in the road with the data being skewed. You've got to actually be on the ground. So like in the accumulator, as like a safe bet, you're not going to screw this thing up. You're going to be getting in, in hopefully the first 12 months and then ride out the next 12 months to 2 years. And that could be 10 to 20% growth per year. There was a suburb I did an analysis on 4 months ago in Western Australia. It's grown 10% in 4 months. And I was just looking at the data, but it's probably only got 6 to 12 months to run, if that. But look, it might do another 10 or 20% in the next 6 to 12 months. So with development, what I've always done is actually buy in this downturn stagnation period. So if you have a look at this growth, I've identified that I've either, this area has grown and I'm in this 2 to 5 year window, but because my projects are a bit bigger, it might take me 2 years to get approval on some of these. So I'm going to guess that I'm in this section. I know people try and brag that they pick the bottom of the market and all that stuff, but I'm talking about sustainably picking, you're not going to pick it down to the exact day, but you might pick the window that might be in, like a 6 or 12 month window in this period. So in a lot of areas, we are going through this stagnation. I'm not saying, don't be buying development sites in the growth cycle. You just got to be careful that if you are buying a development in the growth, that you're not getting in, at the 2 to 3 year, you're not getting in at the peak with a development site, and then you're not riding that downward wave. So when you're in a downward market, you don't want to be getting in the next 3 months after the market started to turn. You actually want to give it some time. COVID was a bit of an exception to the rule because the fundamentals in the property market were really good. And then COVID just scared the crap out of everyone. And then the market went back for those, between whenever it was March 2020 to sort of September 2020, that 6 month window. And then once people realized that the world wasn't going to end, they all started looking at, they started looking at property because there's nothing else to do and they're at home. But they started to enter back into the market around September 2020. And the first markets to boom were actually the coastal markets because people were trying to get out of the cities away. And then the coastal markets boomed, and subsequently after that, the capitals boom. I'm speaking generally here. So what I personally think is going to happen is coastal markets will continue to get some pain in areas, especially those hit by affordability, irrespective of the supply. People physically just can't afford to buy there. If people can't afford to buy, they're not going to be able to pay the prices. And we're going to go through a bit more of a bumpy ride because we haven't felt the effect or the full effect of the interest rate cycle, the interest rate rise and the bank tightening. So I think overall in the Australian market, we've already hit that 2 to 3 years. We're in this 2 to 5 year window in a lot of areas, which I've said for probably the last 6 months or 12 months, you know, this window is the time you should be buying, especially if you're doing development. And there's plenty of opportunities still buy and hold. I think there's only really two main markets that are still in this 2 to 3 year growth phase that haven't seen the back end of it. And there's parts of, I think, South Australia, and there's parts of Perth, generally speaking. There are some Brisbane suburbs, but they're a bit harder. I think they're more kind of in this range here, where you might be waiting 12 months or you might be waiting 2 years for the market to start to pick up. So if you can understand that growth cycle, how it moves through this 2 to 3 year boom, and then you go through the 2 to 5 year stagnation period, you can understand when you want to be buying into property or into doing property development. So it's going to depend on the size of the deal. I know Faye, if you're on, you sent me that deal that I saw earlier tonight. So I was in Logan, so south of Brisbane. If you don't know Logan, it's between Brisbane and the Gold Coast. So with Logan, normally I wouldn't say, you know, go to Logan, but you're looking at a small deal that was sort of in and out in like 12 to 18 months, hopefully, because it was just a land subdivision. It's a pretty quick deal. So in 12 to 18 months in an area such as Logan, so Logan does have a lot of supply coming, but that supply is not going to come to market for 12 to 18 months. It's going to be a lot longer to flood the market. So Logan and like Ipswich, so those areas on the outskirts, they have issue where they go into oversupply. So they go through this big growth phase of 2 to 3 years where everything gets built. And this is what we're going to enter Australia-wide. I'm talking like the global market, there's, sub-markets. So that 2 to 3 year window, that's when you see all the construction, all the cranes. And it's a bit weird now because we kind of went through that, but then it got cut short. So we are still going to see that 2 to 3 year boom cycle to make up for the supply, the lack of supply. That hasn't started to happen in a lot of areas yet because financing is difficult or more difficult, and builders going bust, people are scared about building, all that stuff. So if you're in an area where there's a lot of construction happening, chances are you're going to be in that 2 to 3 year. But for the example of like Logan, we've just sort of come out of that boom where the market has gone up because of the lack of supply. We're in this stagnation period, I believe, and then I think there's maybe another 12 months of that stagnation, and then I think we're going to see even Logan, of all places, we're going to see parts of Logan boom off the back of undersupply, especially with particular product types.